Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about FERMI Inc. Annual Report. FERMI Inc. offers a range of businesses and services that cater to the needs of AI-centric customers in the United States. At its core, the company develops private power campuses specifically designed for these customers. In addition to developing private power campuses, FERMI Inc. also focuses on creating grid-independent energy generation and high-performance computing campuses. This allows customers to have a reliable source of power and computing capabilities, even when disconnected from the main grid. The company's services extend beyond development and leasing, as it also operates integrated power generation and computing infrastructure. This comprehensive approach enables FERMI Inc. to provide a seamless experience for its clients, from land acquisition to long-term leases. Overall, FERMI Inc.'s diverse range of businesses and services positions it as a one-stop solution for AI-centric customers seeking reliable and efficient energy and computing solutions. FERMI Inc. market capitalization of $3 billion is materially smaller than most of its industry peers of roughly $33 billion. FERMI Inc. trades at a higher price-to-book ratio of 2.95 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 22% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be categorized into several key areas. On the growth side, securing long-term lease agreements with AI hyperscale tenants and successful execution of leases with favorable terms are crucial factors. Tenant acquisition and retention also play a significant role in driving revenue growth. Additionally, changes in customer requirements, economic conditions, or competitive offerings can impact revenue growth. Monetization of lease agreements, government grants and public incentives, property tax abatement, federal tax credits, and lease rental income from hyperscaler tenants are other key drivers of revenue growth. These factors contribute to a stable and increasing revenue stream for companies in the industry. On the decline side, delayed or declined execution of long-term leases by anchor tenants, unfavorable lease terms, tenant default, restructuring, or bankruptcy can all lead to revenue decline. Failure to meet operational covenants and performance liability requirements can also have a negative impact on revenue. Reduced investor interest due to reduced disclosure requirements, increased legal and financial compliance costs, and diversion of management's attention from revenue-generating activities are other factors that contribute to revenue decline. Access to capital, macroeconomic conditions, inflationary pressures, tariffs and trade policies, and supply chain disruptions can also have a significant impact on revenue growth or decline. These external factors can either positively or negatively affect the industry as a whole, leading to fluctuations in revenue for companies within it. Net income and profit margins have experienced significant fluctuations over the years. Initially, net income was not applicable as there were no revenues generated. However, with the passage of time, net income began to decline due to various factors such as manufacturing capacity constraints, supply chain disruptions, increased costs, and delays in project development. Profit margins also followed a similar trend, decreasing due to higher labor and training costs, diminished operational performance, and inability to achieve growth milestones. The company's profit margins were further impacted by increased costs from implementing TRS for hedging activities, difficulty in releasing premises, and potential supply disruptions or cost pass-throughs. The decline in net income and profit margins can be attributed to a combination of internal and external factors. On the one hand, the company faced challenges such as manufacturing capacity constraints, supply chain disruptions, and increased costs. On the other hand, external factors like inflationary pressures, tariffs, trade restrictions, and interest rate fluctuations also contributed to the decline. In 2025, the company reported a net loss of $unknown for the period from January 10, 2025 to December 31, 2025. This indicates that the company's financial performance continued to deteriorate in the subsequent years. The decline in net income and profit margins highlights the need for the company to reassess its strategies and address the underlying issues to improve its financial performance. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. A key indicator of this is the generation of positive operating cash flow, which reflects the company's efficiency in managing its resources and converting profits into actual cash. The net change in cash and cash equivalents of $408,529 further supports this assertion, demonstrating that the company is able to retain a substantial amount of its earnings as cash. This achievement is a testament to the company's effective financial management strategies, which have enabled it to maintain a healthy cash position despite any fluctuations in revenue or expenses. The generation of positive operating cash flow also provides the company with the necessary liquidity to invest in growth initiatives, pay off debts, and meet its financial obligations, ultimately contributing to its long-term sustainability and success. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, the total debt decreased from $148,986 to $109,799 after accounting for unamortized debt issuance costs and discount, page 111. However, this decrease was offset by an increase in debt due to the recognition of an operating lease ROU asset and corresponding lease liability totaling $21,737 and $21,320, respectively, page 115. In terms of interest expenses, there has been a notable increase. Interest expenses have increased due to capitalization of interest costs associated with construction in progress, page 101. Furthermore, the interest expense increased by $652 from inception to December 31, 2025, page 115. Additionally, the company entered into new debt facilities with higher interest rates, including a Beal Equipment Financing Agreement, page 81, and an MUFG Equipment Financing Agreement, page 125. The changes in debt level and interest expenses suggest that the company has taken on more debt to finance its operations. The increase in interest expenses is likely due to the higher interest rates associated with these new debt facilities. Overall, the company's financial situation has become more complex, with increased debt levels and corresponding interest expenses. The management is optimistic about the company's outlook despite facing significant challenges. The key strategy revolves around developing Project Matador, a nuclear power generation project that will provide clean energy to the grid. To achieve this goal, substantial capital investment of $70–90 billion across all phases is required. Management is exploring various financing options, including government grants, public incentives, tenant prepayments, debt financing, and equity financings. The company also expects to qualify as a REIT, which will exempt it from U.S. federal income tax at the REIT level if it distributes substantially all of its taxable income. While regulatory delays or changes in policy could impact development timelines and cost structure, management is confident that the company's diversified mix of gas, nuclear, and solar energy aligns with decarbonization efforts. The growing demand for clean energy presents a significant opportunity for the company to capitalize on this trend and establish itself as a leader in the industry. Overall, management believes that the benefits of Project Matador outweigh the challenges, and the company is well positioned to succeed in the long term. Acquisitions and divestitures are significant business strategies that can impact an organization's growth and financial stability. In this context, we will focus on the acquisitions made by FERMI. FERMI has entered into several long-term leases to expand its land holdings, including a 99-year ground lease for a 5236-acre site in Carson County, Texas. This strategic move is expected to provide ample space for multiple AI infrastructure campuses. Additionally, the company has acquired various equipment and assets, such as turbines from GE and Siemens, which will enhance its capabilities. FERMI has also made significant investments in acquiring Firebird Acquisition on July 29, 2025, for $137,000. This acquisition includes a contract with Siemens Energy AB for power equipment and accounts payable. Furthermore, the company issued Series B convertible notes and promissory notes to facilitate this transaction. In terms of divestitures, FERMI has taken steps to monetize its long-term lease agreements through structured financing arrangements. While not a traditional sale, this strategy allows the company to generate revenue from its existing assets. However, it is worth noting that Glorify D/B/ with Purpose, Inc. filed for bankruptcy protection on February 8, 2023, indicating a potential loss for FERMI. Overall, FERMI's acquisitions and divestitures demonstrate the company's efforts to expand its capabilities, generate revenue, and adapt to changing market conditions. The company has a history of paying dividends, as indicated in multiple sections of the extracted summaries. Specifically, it is mentioned that the company has paid dividends on several occasions, including for preferred unit holders at a rate of 15% per annum. This suggests that the company prioritizes returning value to its investors through dividend payments. In contrast, there is no evidence to suggest that the company has bought back shares in the classical sense. However, it did repurchase Class B units from service providers and donated them to Dichamai Asset Trust, which may be seen as a form of share buyback, but with a philanthropic twist. Concerns about inventory buildup or supply chain disruption are evident throughout the extracted summaries. On page 30, it is noted that extended lead times on supplies could result in increased prices, inability to obtain adequate raw materials, backlog in orders for new combustion turbines, and potentially holding more inventories. Supply chain disruptions are a recurring theme, with mentions on pages 20, 21, 25, 26, 35, 36, 37, 39, 48, 49, 59, 60, and 76. These disruptions could be caused by various factors such as global supply chain issues, limited availability of necessary components for equipment, difficulty securing a qualified workforce, changes in trade policy, cyber intrusion techniques, export controls, trade sanctions, retaliatory trade actions, or international conflict. The potential for construction delays due to inflationary pressures and cost overruns is also highlighted on page 59. Furthermore, global supply chain disruptions may delay delivery of critical infrastructure components, as noted on pages 60 and 76. Overall, the summary suggests that there are significant concerns about inventory buildup and supply chain disruption in the industry. That concludes the financial summary for FERMI Inc. Feel free to comment below, and I will be happy to answer them when possible.